Welcome to Study Time, a televised home learning program produced by Rwanda Basic Education Board.
Hello students, welcome to TV learning programs, and as usual I'm Teacher Julius, and today I will be with senior 6 students, and we are still under our unit 5, which is financial statements. And our today's lesson, I want us to look at how we can prepare a cash flow statement. In the previous lesson, we looked at what a cash flow statement is. Cash inflows, cash outflows, we looked at the examples. Then now I want us to look at the preparation of a cash flow statement, how it is prepared, So I have a question which I want us to go through together, and we see what they want us to do. The information bureau, the question goes, the information bureau was extracted from the books of John Enterprises. Then we have 1st April 2018, cash balance worth 2 million. Then we have monthly revenue, the next statement from sales were projected at 300,000. We have rent receivable, as you can read the question. In May, they received a bank loan worth 500,000. We have income from sale of an asset in April. It was 400,000. Then we have credit sales per month. You can see. Then what they want us to do, they want us to prepare a cash flow statement for John Enterprises for 3 months. And then we comment on the net cash position of John Enterprises. So if we can go back to our question. So what is the format that we use here? So we don't have the specific format. In this case, you will look at the required part. They want us to prepare a cash flow statement for 3 months. And therefore, how do you go about this? So you begin with the title, the heading. So which will be John Enterprises. John Enterprises. John Enterprises. Cash flow statement. Cash flow statement. Cash flow statement. For which month? They are telling us we should prepare for 3 months. So our first month is April. As you can see, our first month is April. For April, the second month should be May. From April, you go to May and June. For April, May, and June. Which year? 2018. This should be your title, and that's how it should be drafted. Then from there, you can draw your lines very well. Then we have our cash. This column, it should be the column for details. This column is for details. This column is for April, which is our first month. April. Then this one is for May. Then this one is the column for June, our 3 months. If maybe they had asked us 2 months, then we would have stopped from this. We would have written this column, this, and this. But they have told us 3 months, then we have to look at these 3 columns for 1 column for each month. April, May, June. If they told us 4 months, we should have created another column for July. 5 months, should have included even August, another column like that. If maybe they wanted only April, then for 1 month, we should have stopped from here. We should not have included the 2. So you have to here follow the question very well. So details, then a month of April, May, and June. Then we begin with the cash inflows. Remember, cash flow statement shows the cash inflows and the cash outflows. So in this case, we are going to begin with cash inflows. The cash inflows. Hope now everyone can be able to know that this is a cash inflow, this is a cash outflow, basing on the knowledge that you acquired from the previous lesson. So on 1st April 2018, following our question, we have cash balance worth 2 million. So what's that? In April 2018, first, we have cash balance worth 2 million. So when you look at that, that is cash balance brought down on that period. So April was started, or this John Enterprises started April with cash balance, cash at hand, 2 million. So under cash inflows, you have to write, you have to indicate cash balance. Brought what? Brought down. And this is for April. How much? We have 2 million. 2 million. For April, we can't indicate it in May. Then we have our second statement, which says monthly revenue from sales, we are projected at that. That is also a cash inflow. Monthly sales revenue. Monthly sales revenue. And what does the word monthly mean? This is per month. Per month. And therefore, that is 300,000. So 300,000 should go, or is written in all months, because they are saying monthly. Monthly means per month. So each month, the sales revenue were projected at 300,000 per month. Then we have the next statement, which is rent receivable monthly was projected at 250. So this is rent receivable. This is an inflow. Rent received is an income. In the profit and loss account, remember, we added it to other income. We added it to gross profit. In the profit and loss account, we would add this to gross profit. So rent receivable, rent received, and here they are saying monthly was projected at 250,000. Monthly, so it must go in all the months, 250,000. Hope we are together. Then we have the next statement, which is in May, received a bank loan worth 500,000. In May. Remember, I said, always said that an increase in liability, when you acquire acquisition of a loan, borrowing, that is an inflow. Increase in liability is an inflow. So here, a bank loan was acquired in May. So we have the bank loan. This is a cash inflow, a bank loan, and it was acquired in May. Specifically, this is a cash inflow for May, not April, not June. So you have to indicate it here. So 500,000. So here, nothing was received for April and June. So that's a bank loan. Then we can continue with our question, and we see. We can continue with our question. We have income from the sale of an asset in April. Sale of an asset. This is a reduction in asset. When you sell assets, your assets reduce. But it is an inflow, cash inflow. Reduction of assets by selling is a cash inflow. Sale of an asset. In this case, and they are saying it was sold in April, 400,000. So this figure, this money is recorded in the month of April. Then we have credit sales per month. Credit sales per month were 200,000, and payments would be made in the following month. So I want you to think about that statement, and then you tell me what it means. Credit sales per month were 200,000, and payments would be made in the following month. Our credit sales cash inflows, was that money received? First think about it. Credit sales were made per month, 200,000, and payments would be made in the following month. So where do we put that figure, 200,000? April, May, or June? What does that statement mean? This one is included in cash inflows, the credit sales. So I want you now to understand it. Each month, credit sales worth 200,000 would be made. Each month, goods worth 200,000 would be sold on credit. But the payment of those goods would be received in the following month. So I want you to understand me. So in April, goods worth 200,000 were sold on credit. But the payment was not received in April, it was received in May. So this figure goes here. Nothing was received here. Goods were sold on credit in April worth 200,000, but the payment was received in May. Still in May, because they're saying per month, goods worth 200,000 were sold on credit, but the payment was received in the following month, which is June, 200,000. Again, if you continue, in June, goods were to be sold on credit 200,000, but the payment for those goods sold on credit in June was supposed to be made or to be received in the next month, which would be July. So that is how you look at it. That is how you record that. That's how it goes. Then we have monthly interest paid. You have to see that. That is an outflow because that is a payment paid. So you have to know it very well. So we have to check and see if we have recorded all cash inflows. We have monthly interest paid. You have to see that is an outflow. Bought a motor vehicle. Increase in assets is an outflow. Bought a motor vehicle. You know that cash was spent, fixed costs, and you have variable costs. So in this case now, we have to add up, and we see total cash inflows, total cash inflows, total cash inflows. So the total cash inflows, when you add now, so I want us to add together. This is 2 millions. You add 300,000, this is 2.3. 2.55, then 2.95. So 2,950,000. Let's re-add and see. 2,300,000, 2,550,000, 2,950,000. I think our addition is correct. Is our addition correct? Yeah, you can see. So this is our total cash inflows for the month of April. We shall not add for May. We cannot add for June, simply because we have not ended our month of April. We have to look at what was spent. What is the cash in outflows of April? So we have to first look at what are the cash outflows for the month of April. Cash outflows. Cash outflows. Cash outflows. Now with cash outflows, we can begin with the interest paid on the loan that was acquired. So interest paid. And you have to understand this very well. The interest paid, the loan was acquired in May. The loan was acquired in May. So when do you think this interest was paid? It was paid in the next month, which is June. So here, the interest paid of 40,000, it is of which month? It was paid in June. Because if the loan was acquired in May, then the interest was paid in June. Then we continue. We have bought a motor vehicle, purchase of a motor vehicle, purchase of a motor vehicle, purchase of motor vehicle. Here, this is cash outflow. When you purchase, you have to pay out money. Money goes out. So purchase of a motor vehicle, 500,000, and they're saying it was bought in April. So you have to record it in the month of April. So here, nothing. Then we have fixed costs monthly. Fixed costs monthly, we are projected at 300,000. Remember what you talked about when it comes to fixed costs and a break-even point. senior 4. Costs which don't change with output level, which include the rent expenses. So these ones, the fixed costs were projected at 300,000 monthly, 300,000 monthly, 300,000 monthly. Then we have what we call, we have again variable costs. Variable costs, these are costs which change with the level of production. If the production level increases, variable costs will also increase. If it reduces, they also reduce. For example, we have like purchase of raw materials, those are variable costs. Salaries of wages of temporary workers, those are variable costs. They change with output level. So here, the variable costs, the variable costs were projected monthly, they're saying per month, at 250,000 per month, 250,000 per month. Do you have any other cash outflow? So you have to check if you have listed all other cash outflows. So you have to check. So back to our question, you can check if there is any cash outflow that we have not recorded. Fixed costs we have recorded. Monthly interest paid we have recorded. Purchase of motor vehicle we have recorded. Then variable costs we have also recorded. So now you can see the total cash outflows during the month of April. Total cash outflows. Total cash outflows. So this is 500 plus 300. This is 800,000 plus 250. This gives you 1,050,000. 1,050,000. So what does this one indicate now? I want us to look at our month of April. It means that our cash inflows during the month of April are greater than our cash outflows during the month of April. Now, let us try to balance. Remember in the previous lesson, we have to balance. We have not finished April. We have to see, we are finishing April with how much? And that will be now what we call the balance carried down. The balance carried down, we shall base on this state the net cash position. What is the financial stand of the business? So now you get cash inflows of the month of April, subtract cash outflows of the month of April. So get 2,950,000, subtract 1,050,000. What do you get when you subtract 2,950,000? So those who have no calculators, you can do it in this way. 2,950,000, take away 1,050,000. We are subtracting 0, 0, 0, 0. 5 minus 5, 0. Here we have 9. 0, here we have 9, then here we have 1. So this is 1 million. So you have to subtract where 0, 0, 0. Then here we have 0. 5 minus 5, we have 0. 9 minus 0, we have 9. 2 minus 1, we have 1. So it is 1,900,000. So that is what you remain with. 1,900,000. So in this case now, we shall have 1,900,000. So this is our balance carried down. So our balance carried what? Carried down. So we shift it to the next trading period. Because we have finished our April with this balance, so we have to shift it to the next month. This is now cash balance brought forward for the new month of May. So then you add now. And you add from here 1.9. So this is 1,900,000. You have to add 300,000. That gives you 2,200,000. When you add this, you will get 2,450,000. 250,000. So you have to add 1.9 plus 300,000, that is 2,200,000. When you add 250, that is 2,450,000. Then 2,950,000. Then you add 200,000. That gives you 3,150,000. 3,150,000. 3,150,000. Then you add here. Here we have 550,000. When you add here the cash outflows of the month of May, 300 plus 250. So, during the month of May, still our cash inflows are greater than our cash outflows. Still now subtract this one, you subtract this. So if you get 3,150,000, then you take away 550,000. So what do you get? 0, 0, 0, 0, 5 minus 5, 0, 1 minus 5, impossible, so 11 minus 5, 6. Then here we have 2. So this is 2,600,000. When you subtract 2,600,000. So this is our balance carried down at the end of May, which must be taken to the month of June as balance brought down, cash balance brought down. 2,600,000. Then you have to add. You add from here. 2,600,000, add this, you add this, you add this. So when you add, this is 2,600,000. When you add 300,000, that is 2.9, or 2,900,000. Then when you add this, 3,150,000. When you add this, 3 millions, then 350,000. So you can add and see if it's very correct. From here up to here, if it's very correct, then you again add the cash outflows for the month of June. This is 40,000, the interest that was paid. Then you add 300,000. This is 340. Then when you add this, this will be 300 and that will be 590,000. 340 plus 250, 590. Those were our cash outflows during the month of June. So get this and subtract this. So you will get 3,350,000. Take away cash outflows of 590,000. So if you subtract 0, 0, 0, 0 minus 0, 0, 5 minus 9, impossible, 15 minus 9, that gives us 6. Here we have 2, 2 minus 5, impossible. You borrow 1 here, 12 minus this one, 7. Then here we have 2. Is it what you are getting? 2,760,000. 2,760,000. So here, this is our balance carried down for April, for May, for June. Now, I want you to look here very well. I want you to check, because you may be asked to state the net cash position, and that will be, you will have to complete that. You have to base here, look at April. We have 1.9. Is this a surplus or a deficit? Cash inflows were greater than cash outflows. Here we have 2.6, 2,600,000, 2,760,000. So when you can look at this, we have a surplus here, we have a surplus, we have a surplus. So the 3 months, there is an increase in the net cash position of the business. That should be your comment on the net cash position, because we have 1.9, 2.6, 2.76. So the surplus of the business keeps on increasing, or it increased during the 3 months. So there is a general increase in the net cash position of the business. That should be your general comment. Comment on the net cash position. We have a surplus in April, we have a surplus in May, we have a surplus in June. And when you check this, the general comment generally, there is an increase in the net cash position of J1 enterprises. I think that's okay. So I want you to write the assignment, the homework, and then as you try it out, as you write, then I will be commenting on some things. If you have a deficit, for example here, if in the month of April we got a deficit, if this 1.9 was a deficit, this deficit must be brought here. You must carry it to the next month. You can't leave it. And remember that deficit, we put it in brackets, and it reduces the cash inflows of that very period. So a deficit will reduce the cash inflows of the next period. You don't leave it there, a deficit, where cash outflows are greater than cash inflows. I know some of you may be asking yourself such a question. So you have to know, if in case I get a deficit, how do I treat it? If you take it to the next period, it reduces the cash inflows of that period. Then we have that one. We can continue as we finish up our question. As we finish up the question, I want you in that question to prepare a cash flow statement for the first 2 years, stating clearly balance brought down at the beginning of the second year and balance carried down to the third year. And balance carried down to the third year. So you can again check the first number of our question. I know some are slow. And make sure you analyze it. 1st January 2016 started with cash 200,000 and a bank loan. You have to analyze that way. A bank loan of 2 million, which was to be paid in 4 years in equal principal installments at a fixed interest rate of 5% per annum. In that statement, we have cash inflows and cash outflows. Loan payment, interest paid. Those will be included in the cash outflows. But the bank loan, the 2 million, is a cash inflow in 2016. So you have to analyze that way. And the rate of interest here is fixed. You can even have a question where the interest rate is paid on reducing balance basis, whereby as you pay the principal or the loan installment, then the interest in the next period reduces, reducing balance basis. But in this case, the interest rate is fixed. It will not change for the entire credit period or loan payment period. So you have to analyze that. In that statement, that is where the trick of the question is. So be able to analyze it well, and you get it out. So thank you very much for listening and watching. We'll meet next time. Bye-bye.